Hi folks, and welcome back to Meaningful Money. Okay, still here in the conservatory of my parents-in-law because it's still raining outside. Looks like it might be brightening up, but I need to get these done. Now, I've been chatting to some clients recently about equity release and was reassuring them about one of the biggest concerns of anybody really who's considering taking out an equity release mortgage. So I just want to deal with that here. But before we do, as ever, let me say thank you to my friends down here in the bottom right. That's Seven Investment Management, who continue to sponsor me, for which I'm really, really grateful. Now, one of the biggest concerns for people considering taking out an equity release mortgage is that because the interest rolls up on those mortgages and you don't pay it off monthly, instead you borrow an amount of money and the interest on it gets added to the loan. And because it rolls up like that, people are concerned that it will roll up really quickly and it will eat up all the equity in their home. It's an understandable concern because people want to leave their kids something. Very often their house is the biggest asset they've got. They want to leave it, or some of it at least, to their children, but they like the idea of having equity release, releasing some money to help them pay the bills, or to have a holiday, or to enjoy the final years, whatever. Now here's a rule of thumb. On a loan which rolls up like that, at 7%, the amount you owe will double every 10 years. So if you're paying 7% interest, the amount you owe will double every 10 years. So if you borrow, here's the seagull, if you borrow 25,000, well at 7%, in 10 years time you will owe 50,000. And in another 10 years after that, you will owe 100,000 because it'll double again. Let me show you how that works as far as equity release is concerned and the value of your home. Okay, here's a little chart just to illustrate what I mean. Now, on the bottom here are time scales, so 10 years and 20 years, and money is up here on the left. So we're talking about a loan doubling every 10 years. That's assuming a rough interest rate of 7% and where the loan rolls up like equity release mortgages usually do. So on that basis, if you start with 25,000 and it's going to double every 10 years, you'll end up with a loan which follows a sort of rough curve. Okay, it'll be a lot more regular than my drawing, but the amount of loan will go up like that. And here at the 10-year point, it'll be 50,000, and at the 20-year point here, it'll be 100,000. But the distance between the amount you've borrowed, 25,000, and the value of your property at outset is, this space here, and that's called the equity, and it is £225,000. Yeah, the value of the house less the amount you've borrowed. And let's just say that you want to keep that amount of equity constant. Well, in order to do that, then the value of the house needs to go up over time as well. And it needs to follow roughly the same curve. So at the halfway point, the house is worth 275. That's after 10 years. And then again, in order to maintain that same distance between the amount owed and the value of the house, then the value of the property at this stage needs to be 325,000. So can you see that hopefully the difference between these two values, the amount of the property and the amount outstanding, is still £225,000. Now, we know the interest rate on the loan, that's going up by 7% a year. But here on the property value, how much does it have to go up each year to get from 250,000 to 275,000 in 10 years? Well, the answer is, that sort of space there, it's only growing by 1% per year. So if you think house prices are going to go up by 1% a year, and you borrow a 10% equity release mortgage, house prices only have to go up by 1% a year in order for you to maintain the amount of equity in your home. Now, if we're looking over 20 years, then house prices to get from 250k to 325k is a 1.5% per year simple increase in the house price. Okay, now at 50,000, if the loan doubles every 10 years, then it's going to be 100,000 here after 10 years, and it's going to be 200,000 after 20 years. Now this is now 20% loan to value. So 50,000 on a property of 250, you are borrowing 20% of the value of your property. And the equity here now at outset is 200,000. So if you want to maintain that, then your property is going to have to go up. It's going to have to follow that similar kind of curve. And if you want to maintain a £200,000 equity, then your property's got to be worth 300,000 here and 400,000 here. Now, that is 2% growth in the value of the property per year, simple, to go from 250,000 to 300,000 in order to keep the equity value the same. So you can see the house value doesn't have to work too hard to keep your equity value the same. But just a couple of caveats. Let's draw a line here. Obviously, if you're aiming to keep the equity in your house at the same pounds value, your biggest killer is going to be inflation. Over 20 years, even though the pounds value might be the same, between the amount you owe and the value of the property, inflation will actually have significantly reduced it. So, it's theoretically possible to maintain the pounds value, but in real terms, it will go down. So really, you want your house price in this example to go up not just by 2%, but by 2% per year plus inflation would be perfect. Now, just remember, equity release is not to be taken lightly. I do this just to put some minds at rest. It's a question I get asked often, but you should certainly seek specialist advice from a qualified IFA who knows what he's talking about when it comes to equity release, and also from a solicitor. Really important that you see both of those and get some decent independent advice before you take on any equity release contract. Okay, hopefully you can see that the most people's fear about losing all of the equity in their home when they take out an equity release mortgage is unfounded. It's just not as bad as that. Chances are property prices will go up a little bit, and you can see that they don't have to go up too much in order to keep pace and keep that equity where it is. But hopefully that's been clear. Set your mind at rest a little bit. I've got a whole series of videos on equity release. I'll put a link there. That link is for episode 137, which is the first one of that series. I believe there's 9 or 10 in that series. So start there, and it'll lead you on to the next one. So thanks for watching this one, and I'll see you next time.